Good morning, everyone. Welcome to Pre-Market News and Views by In the Money Stocks. Today is Friday, March 8th, 2013. Thank you for tuning in. Let's take a look at the charts here. We'll start off with the usual S&P 500 E-mini futures. You'll see that the futures are trading higher again. They're trading up 4.25 points to 1547 per contract. So decent little pop on the futures ahead of the opening bell today. In about 5 or 6 more minutes, I believe we're going to have the non-farm payroll report for the month of February, and that will be released by the U.S. Labor Department. So we'll see how the market plays out there. There could be a market-moving event, but right now I don't think the markets are really all that concerned about the job number. I do think they're more concerned about the money that comes into the market by the central banks. So we'll see how that plays out. Let's take a look at a couple of other things. Let's take a look at the gold market. Right now we have Right now we have the gold market trading up 1 point to $1,576 an ounce. Let's take a look at the GLD. You'll see that the GLD is trading down a little bit to around 152.58. Yesterday the GLD closed at 152.69. So we're not going to make too much out of that market right now. Gold has been beaten down. There is quite a bit of support here for gold though on the bigger time frame. So again, I don't really expect any major decline on gold. In fact, it actually does look attractive for aggressive traders to the long side. So I wouldn't really expect anything all that dire for gold at this stage of the game. But again, it's just a trade, not a long-term hold at this stage. Let's take a look at oil. Light sweet crude is trading down by 50 cents to $91.06. So a decent little dip down on light sweet crude. Let's take a look at the USO. Here you can see USO is trading at $32.74. That is about 20 cents lower, or 22 cents lower than yesterday's close, which was $32.94. Again, the culprit for lower oil today is very easy. It's just a stronger dollar. The dollar is up 14 cents on the U.S. dollar index futures. So when the U.S. dollar index futures are higher, gold prices, gasoline prices, they will decline, and that's what we're looking at the moment. The stock market used to decline on a stronger dollar. That has not happened since every currency in the world is deflating themselves or devaluing themselves. So again, you have Japan devaluing their currency, and England and the European Union. You have the Federal Reserve here. Everybody's printing. So the dollar is the best of the bad batch, I guess, at least for now. I don't know if that will always remain the case, but in any case, today it is, and the dollar moving up is pulling back oil. Not really having much of an effect on gold, but it is pulling back oil. Ultimately, what traders don't realize, or at least what they don't seem to be realizing right now, is that a stronger dollar will hurt the multinational companies. So a lot of the Dow Jones components that do business overseas, when the dollar gets stronger, their earnings will be weaker. So that's something to take into consideration down the road. But right now, not a big deal. If we take a look at the European markets today, right now they're up across the board. German DAX is up 0.6%. The French CAC 40 is up 0.8%. And you have Spain up 1.6%. So everything is soaring and roaring. No problems in Europe today. Everything is cured over there. And then when you look at the Asian market, you had a huge move last night in the Nikkei. That was up 2.6%. So Nikkei looks like it's doing what we call a two-step. 2 steps forward, 2%, and then 1% decline. Then it takes off again, 2% forward, and then 1% decline. Very volatile up here at these highs. But nonetheless, the Nikkei makes highs almost each and every day. You can take a look at the EWJ, which is a good ETF. And if you take a look at the daily chart, you'll see that this thing has gone from $8.80 all the way up to $10.50. I know it doesn't look like all that much, but that's a gigantic move for this small, low-priced ETF. And that's just something resembling the Nikkei of what it's done recently over the last 3 months. This index went from 8,000 now over 12,000. It's pretty dramatic when you think about it. The job report will be out in just about 2 minutes, so we'll stay tuned for that, and we'll see where that takes us. Let's just look and see what economic news we have out here today, if there is any. Yeah, I believe at 10 o'clock we are going to have wholesale inventories that will be out, released at 10 a.m. Other than that, it is a Friday. On Fridays, we normally look for a flat to slightly positive trading session. Here's a stock that is getting hammered today. It's called Skull Candy. Again, I think they make headphones or something. But this stock, if you take a look at this 10-minute chart, yeah, not too pretty. Trading down around the 5.5 level. This stock ultimately looks like it wants to go down to $5. There's not much you could do about it here. All right, looks like the job report is out. Markets are getting a quick little pop. So big pop there for after the job number. I'm not sure exactly what the number is here, at least not yet. But I do see that the report is released. Markets are getting a pop up. Looks like 236,000 new jobs created in the month of February. 236,000 new jobs. So that should put the market in somewhat of a rally mode. The dollar will spike off of this, so keep that in mind. If the dollar moves higher, that is a negative for the stock market because it means that the Federal Reserve may have to start to raise interest rates. So take a look at the dollar here. The dollar is soaring and roaring. What a pop up on the dollar. So tremendous move on the dollar there. We'll see if that holds steady throughout the session. I'm not 100% sure it will. And then you have a nice pop in the futures, but they're starting to come back down because if the stimulus has to be taken out of this market, all bets are off. So again, market is a forward-looking mechanism, and traders need to be aware of that. But the job report today, 236,000 in the month of February, beating the number. I think the consensus was for 170,000. But you can see how they get this big spike. I think by the end of the day, you could spike again up there. But in the shorter scheme of things, it's a negative because the stimulus is going to be taken out by the Federal Reserve. Or at least that's what the call will be from the market. So the key today is going to be to watch interest rates, see where interest rates go today, see how they're trading. Just out of curiosity, I do want to take a look at the TLT today. And we'll see the TLT, not doing much here at the moment. Take a look at the IEF. Yeah, coming down a little bit. So yields will start to rise. And then that's something we'll have to watch for. So if bond yields start to rise, that is the market's way of saying, hey, Mr. Federal Reserve, Mr. Bernanke, you may need to raise interest rates. So big pop. But look at the dollar here. Dollar is just soaring and roaring. And that ultimately is going to be a negative because it's just telling you that the multinationals, such as the Dow Jones Industrial Average components, they're not going to have good margins next quarter. So again, something to watch for. But nonetheless, it is a beat on the number, and markets after a big initial spike are right back where they were, and that's pretty amazing. But again, the markets are thinking, hey, the stimulus now needs to come out. The job market is getting better. Can't keep rates at this low rate. Inflation will just skyrocket to new heights, and that is the danger that the Federal Reserve plays when they print all this money, and not just the Federal Reserve, all these countries, Japan included. So again, we'll see how the market plays out. We normally look for a flat to slightly positive day on Friday. I don't see any real reason to change that today. With that said, everybody, I want you all to have a great trading day, and we'll see you on the charts tonight. Take care, everybody.